Hey guys, in this video, we're going to talk about how to maximize your tax-free Roth retirement strategy. As America's IRA expert Ed Slott says, it's about moving assets from forever taxed to never taxed. In part 3 of my series, How to Create a 100% Tax-Free Retirement Income, we learned what the optimal amount is to have in a traditional 401k and IRA to create tax-free income in retirement. Now, let's learn the steps to maximize what is, in my opinion, the biggest advantage for retirement planning in the tax code. No matter what your income, the current tax code offers tremendous opportunities to create, grow, distribute, and pass on assets tax-free. Let's get to it. Colin Exelby here, and I'm a certified financial planner professional, and I provide financial planning for business owners and their families that just makes sense. I own the financial advisory practice, Celestial Wealth Management, and provide advice virtually to clients all over the country. Before we get started, this is as good a spot as any to point out important disclosures. The information in this video, it's for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. Let's talk Roth. Everyone loves Roth, except maybe the government that created them. More on that in a minute. So why does everyone love a Roth IRA? Roth IRAs have become so successful for some that the current government is looking at ways to cap access to them for certain people and to force distributions for others. So it's really important to be taking advantage of this strategy if it makes sense for you. Why does everyone love a Roth IRA? In 1997, the Roth IRA was created to allow people to put away money and forego a tax deduction. In exchange, you get tax-free growth and tax-free distributions. And if anything is left over after you pass away, your heirs can withdraw those funds tax-free as well. The government thought this was a great way to incentivize saving for retirement, as many pension plans were going away at the time. It also allowed them to collect some taxes right away. But many people who qualified still didn't contribute. People believe that they will be in a lower tax bracket in retirement, but that's a myth. Many people are in a higher tax bracket in retirement, given the combination of retirement income, those increasing RMDs that we talked about in episode 3, and Social Security. But not everyone can have these accounts. When these accounts were created in the late 90s, they were limited to Americans making less than $110,000 or $160,000 jointly, and annual contributions were limited to only $2,000. Well, fast forward to today, and now if you make less than $144,000 in 2022 or $214,000 jointly, you can contribute up to $6,000 if you're under 50 and $7,000 if over 50. And if you do qualify, in order to have those tax-free and penalty-free distributions, all you have to do is have the account a minimum of 5 years and avoid taking earnings distributions until after age 59 and a half. All of your Roth IRA contributions can generally be accessed without penalty, so they can also act as an additional supercharged emergency fund. Remember in part 2 when we discussed the current tax brackets? They are significantly lower than in 2017, and many more people qualify for the lower brackets because of the increased income thresholds. It may make a lot of sense to forego the current income tax deductions of a traditional IRA or 401k deduction in favor of all the future tax-free growth of a Roth IRA or Roth 401k. When traditional 401ks and IRAs were created back in the 1970s, tax rates were much higher. In fact, here are the married filing jointly tax rates back in 1978. That's the year I was born. Just look at how much higher tax rates were back then. It made a lot more sense to take the tax deduction then and just hope for lower rates. It's exactly the opposite now, and is another reason allocating to Roth IRAs makes sense. What about when it's time to withdraw the funds? Are there the same requirements as traditional IRAs and 401ks? No. Roth IRAs are not subject to a required beginning date or a required minimum distribution. You never are required to take the money out if you don't want to. In fact, you can actually keep making contributions past age 72 if you qualify and still have earned income. But for many, an ideal strategy is to withdraw Roth assets in retirement. You know why? Well, of course, they're tax-free. You know why else? They don't count as provisional income and do not make Social Security taxable. This is one of the key points to a 100% tax-free retirement income. If you take away one thing from this video, it should be that Roth IRA distributions are tax-free and do not count toward the provisional income that can make up to 85% of your Social Security taxable. They are much more optimal to use in coordination with your traditional IRA distributions to keep your taxable and provisional income as low as possible. All right. The second part of the Roth strategy is to take advantage of the Roth 401k. Wait, Roth 401k? Did you know that most employers offer both traditional pre-tax 401ks and Roth after-tax 401ks? While they are available to over 86% of retirement plans, according to the PSCA's most recent survey, only 26% of participants actually make deferrals. Are you a solo entrepreneur? If you're making use of the solo 401k, you can also have a Roth 401k. Many solo entrepreneurs or partnerships still use the old SEP IRA where the only option is pre-tax deferrals. I would think twice about that. In fact, I created this video that explains the differences between a solo 401k and a SEP IRA in more detail. Check it out. The biggest difference between a Roth 401k and Roth IRA is that the Roth 401k doesn't have any income constraints attached to it. You can make $1 million of income and still contribute up to $20,500 in 2022 if you're under 50 and $27,000 if you're over 50 into a Roth 401k. That is a quick way to accelerate your tax-free retirement savings since you can contribute much more than the Roth IRA. The best part is almost anyone can do it. Roth 401k contributions can also generally be accessed without penalty, so they too can act as an additional emergency fund, a potential much better way to have an emergency fund than sitting in a low-yielding savings account. If you qualify, are married, over 50, and love this idea, here is how you and your spouse could get up to $68,000 in total contributions to this Roth strategy in 1 year. 2022 Roth 401k contributions. You put in $20,500 plus $6,500 as a catch-up, and you get $27,000 for you and your spouse. 2022 Roth IRA contributions. $6,000 in plus $1,000 in the catch-up equals $7,000 each. Total, that's $34,000 for each of you, or $68,000 for both, all in one tax year. Mind blown. But Colin, I'll be paying more in taxes now, and those funds will not get to grow for retirement. They are permanently lost. Wouldn't I do better to take the deduction now and have those funds grow pre-tax? This is an extremely common question, and I want to put to rest this concern right now. The number one factor here, by a mile, is taxes. The difference between the rate you pay now and the rate you will pay later. If tax rates remain the same or increase in retirement, using the Roth strategy will be better. It's not about inflation, earnings, or the opportunity cost. It is all about tax rates. If tax rates are the same at contribution and later in retirement, the end result would be exactly the same. Let's do the math. Here are the assumptions. We're going to start with a $10,000 contribution. Lifetime investment earnings of 200% and an assumed tax rate of 30%. As with any financial planning, we've always got to start with these assumptions, so that's why they're here. All right, here are the calculations. Traditional 401k contributions. You take a $10,000 contribution after 200% lifetime earnings equals $30,000. $30,000 times a 30% tax rate as you distribute the funds is $9,000 in taxes paid. So the net after-tax IRA balance from that initial $10,000 is $21,000. Now let's look at a Roth contribution. You're going to pay $3,000 in taxes up front, right? Because you have a $10,000 contribution going in times 30%, so you pay the $3,000 in taxes. Now you have $7,000 to invest. $7,000 after 200% lifetime earnings grows to $21,000, the exact same amount. That is because it's all about the taxes, and the taxes you pay in the beginning versus the taxes you pay at the end. Joel Dixon, Vanguard Group's head of enterprise advice methodology, told the Wall Street Journal in 2019 that the only factor to consider is current tax rates versus future tax rates. With Roth IRAs and Roth 401ks, you will never have to worry about the uncertainty of what future tax rate increases could do to your retirement savings. And because distributions are tax-free, they also can lower your retirement income to a level where there is less of a chance of hitting the Medicare premium surcharge known as IRMAA, and it can keep your Social Security tax-free. For most Americans, but especially those who are in lower income brackets, say 24% and below, I think this is a significantly underutilized benefit if future tax rates rise. Creating a balance between tax-deferred balances and tax-free balances gives you flexibility as you approach retirement. I love flexibility. I would strongly consider an approach where you take advantage of both the pre-tax traditional 401k and the post-tax Roth 401k contributions. You can actually figure out the ideal amount to contribute to your pre-tax 401k and your post-tax Roth 401k with some basic calculations. To create your optimal tax-deferred retirement account, use a future value calculator like one from this site, or good financial planning software like this one from Right Capital that I use. You would input your current balance, the amount of years until you reach age 72, your annual rate of return, and then try different annual contribution amounts plus employer matches until you reach your optimal tax-deferred retirement balance that you figured out in part 3 of this series. Then you can subtract that annual amount, your portion of it, not the match, from your annual contribution limit to determine the amount that should go into the Roth 401k side. Once you've maximized this strategy, if you qualify, you would want to make your annual Roth IRA contributions. This can help you create your very own 0% tax bracket in retirement by taking advantage of today's low tax rates. Whew, wow, that is a lot of information that I just covered, but the Roth strategy is so powerful, I want you to understand it. In order to maximize this Roth strategy, you will want to watch this video next to learn how to optimize your Roth IRA conversions with the most powerful way to build tax-free wealth. Get clear, be clear.